At the INSEAD Leadership Summit in Asia, we're joined by Rakesh Mohan. You are former Deputy Governor of the Reserve Bank of India. You're currently at Stanford University as a visiting professor. You left the Central Bank of India about 6 months ago. But how would you assess the current state of the economy in India?
I think that if you look at the past first, we had a very creditable and high rate of growth between 2003 to 2008, around 8.7% average. Then with the global crisis, came down to 6.7% in 2008-9. Our fiscal year, of course, is from April to March. And 2009-10, we're expecting around 6% plus, around that level now. And that, of course, is very gratifying that we've been able to survive the current crisis, global economic crisis, with these kind of rates of growth. The question is, what will happen in the future? Can we go back to the 8-9% growth rates? And I believe we can, because one of the things that is very interesting and special, and I would say also that is somewhat shared with most of the Asian countries, is that the Indian corporate sector has turned out to be in pretty good financial health. So despite the turndown, despite the drop in exports and so on, we don't hear of any significant stress in the Indian corporate sector. Second, that we've had a long record of our savings rates going up. Whereas there will be some dip because corporate profits have come down, also the government deficit has gone up because of the fiscal stimulus, so there will be some dip. But overall, I think that one can say with relative degree of confidence that unless there are more accidents that the world has in store for us, that assuming that the world comes back to some degree of normality over the next 18 months or earlier, that we should come back, given the high savings rates and investment rates and the financial stability that we have ensured.
But is the worst over in terms of the recession?
It does seem that the worst is over in terms of the recession, both globally and in India.
And what would be the impact of the weak dollar for the Indian economy?
I don't think that we get specifically affected that much by the weak dollar. The issue in some sense for us is not so much the weak dollar, but will we get another bout of very large capital flows? That on the one hand, a certain degree of capital flows are very welcome, that you want FDI to continue, you want portfolio flows to continue to help in fueling the Indian growth. On the other hand, there's up to a certain extent. Beyond that, it becomes very difficult to manage, because you then, that if the external capital flow is much higher than the current account deficit, it then just goes off into reserves. Each time that you buy a dollar, you inject equivalent amount of rupees into the system, which you then have to sterilize. So that issue, I think, can come up, not just for us, but other Asian countries as well, given the extended expectation of low interest rates in the United States and Europe, which is again, the liquidity is again running around looking for yield. And so I think that is an issue that we'll have to manage again.
But from what you're saying, it sounds as though the Indian economy hasn't been particularly hard hit by the financial crisis, the global financial crisis, and that you may see some moderating of growth, but that's about it.
Yes, let me just qualify that a little bit, that the sector, one of the reasons for this in terms of the macro growth rate is that we now have the service sector accounting for around 60% of the economy, agriculture around 20%, and the rest industry. Industry was pretty badly hit in the sense that the growth rates came down to around 2%. They have now started going up again. That exports were hit, again, like they were for the rest of Asia. They seem to be also recovering. And so I do believe that our recovery, there isn't a significant domestic problem. There is an issue on how fast the global economy recovers, which will, that's sort of the difference between doing 6 to 7% growth or 8 to 9% growth on a sustained basis.
Do you think that infrastructure is now going to be one of the key issues for India? It's recently had Kamal Nath talking in Singapore about the amount of huge amount of road building that's going to be taking place.
Yes.
You yourself were in charge of an expert group looking at railways, and we've seen a turnaround in Indian Railways fortune.
Yes.
How do you see things progressing?
Well, basically, I think if you go sector by sector, let me first talk about the most successful sector, which of course is telecom. And we now have just under 500 million cell phones in the country, increasing by 10 to 15 million per month. So telecom seems to be in good order, and we are in the process of moving to the 3G, which should happen in the next few months. Second, ports, the success is somewhat middling, but I do believe that there's not a big issue out there, because there is no issue in terms of returns that investors can get, because port tariffs essentially are good enough to provide the cash flow for investment in ports. Third, airlines and airports I think are in process. We've had privatization of Delhi airport, the Mumbai airport, and new airports in Hyderabad and Bangalore. So I think that process also is in action. Roads, we started the highway construction program at the turn of the century, that is turn of the decade, in 2000-2001, and it has perhaps been somewhat slower than one might have wanted, but again, there isn't a financing problem there. There are certain implementation issues to do with land acquisition, so I think that given the determination of Mr. Kamal Nath, one would expect and hope that that will get accelerated again. Significant problems continue in the power sector, and there's an issue of cash flow. That is because we still have problems to do with tariffs, highly subsidized tariffs to certain sectors, particularly agriculture. Also collection problems, in the sense that even at the low tariffs, not all tariffs are collected efficiently. And so there's a problem in getting cash flow, whether it's public investment or whether it's private investment. Some of those problems do continue, and I think it needs much more policy action to make sure that improves. One major area of infrastructure which is being tackled, there's a national Jawaharlal Nehru National Urban Renewal Mission, on which there is much greater allocation of funds from the central government. But I do believe that much more needs to be done for improving urban infrastructure and urban efficiency in the country. And I think all you need to do is to visit any Indian city, and you can see that that's an issue. And that's very important, because that affects all-round efficiency of industry, of services, because if you have cities that are clogged, if water supply is not good, if the roads are not good, if transportation is not good, all these problems arise. So I think that that is an area which does need much greater attention. As far as the railways are concerned, I think that some of the changes that were made in the railways in the last 5 years or so have clearly had a turnaround for the railways. The question is that if you look at the next 5 years, are those changes enough? Do we need much greater new investment, which I believe we do? I do hope that the dedicated freight corridors will actually get implemented. They're still in process. We're not quite sure how well they'll be implemented. I think some of those questions remain.
And for the cash that's needed for these projects, that would be from private-public partnerships on the whole?
I think once again, one needs to go sector by sector. That, as I said, telecom, there's no issue. There's enough private sector money in it because cash flows are clear. In the case of power, there are certain issues to do with the tariff charging and the collection of tariffs. So whereas in principle, there's no reason why private investment can't go into power, but it's peculiar problem that we have of what I just mentioned, of not collecting of tariffs. There's a cash flow issue. I think in the case of roads, if you look around the world, there's really no country, without exception, in which the majority of roads, including highways, are not in the public sector. So whereas I do believe that some of the high density corridors, you can have a large degree of private investment, it's not so easy to do that. And so I think there has to be some sense of realism in terms of how much private investment we can get in roads that are not that highly densely traveled. Ports, I think, in principle, there's no issue in terms of private investment coming in. Urban infrastructure is very difficult to get private investment. Again, I think in most countries, there's a lot of variation, but most of investment, urban infrastructure, is public investment. Even in the United States, airports are almost all public sector, water authorities almost all public sector. And in all of these things, I think the issue really is to be able to improve our user charges so that whether it's the public sector that invests or the private sector that invests, you actually get returns on those investments so you can go further and keep investing, because our urbanization process is nascent. We are less than 30% urbanized. Over the next 30 years, next 50 years, it's going to continue increasing like in China, and so we have to be concerned with that.
You've just been speaking here at the INSEAD Leadership Summit in Asia about regulation of the financial sector. You took part in drafting G20 regulations. Do you think the regulations by and large go far enough that we have today?
They clearly do not. I think that two or three kinds of questions. I think that, and of course I'm biased since I was involved in the process, that I think that the G20 definition of the problems as well as the solutions is on the dot. But the kind of problems that exist are the following. One, that we are talking about tightening of regulation. On the one hand, we are saying that all systemically important financial institutions should be equivalently regulated.
So that's at the basis of the definition, that all
that's right.
financial institutions
Whether it's
should be
hedge funds,
treated
whether it's
equally.
banks, whether it's financial institutions and so on. There are practical problems in actually identifying what is systemically important. The second issue is that we are still coming out of the crisis. And in fact, as the session this morning, I forget but one of the sessions this morning was talking about cyclicality in the financial sector. That obviously, there's a general agreement, I think, all around, that you need to increase capital requirements of financial institutions and lower leverage. In fact, that was very well covered in one of the sessions this morning. Now, what that means is that during the current time, when you do have the contraction, that if you try to enforce that increase of capital at this time, it would mean that those institutions will have to sell off assets to reduce the leverage. That itself will cause problems. So the practical issue is, whereas there's general agreement that you need to do that, on how do you time it right? That's a practical issue. The third is to do with what you might call systemic regulation, that there is general agreement on a principle basis that in addition to monetary policy governing what happens to the financial sector and the macroeconomy in general, the new issue or the new realization that has come is that in financial regulation itself, which has traditionally focused on regulating individual financial institutions, that there is need to look at them collectively and do macroprudential regulation. So there's a lot of work to be done how to do that. Who will do it? Will the central bank do it? Will there be sort of a college of regulators led by whom in different countries? Should it be the Treasury? Should it be the central bank? I think there are many of those practical issues that need to be resolved, despite the fact that there's surprising degree of consensus on the end objectives of what needs to be done.
In India, you're saying that the situation didn't get out of hand because the central bank is the regulator.
I'm biased, of course, since I was in the central bank, and so we do feel that we did some right things, but I do believe substantively that we were helped by the fact that financial regulation of the banks and non-banks were the responsibility of the Reserve Bank, along with the Reserve Bank, be the monetary authority. And I can illustrate that by a couple of examples. That, say in the United States, many problems have arisen because of excessive growth in housing finance. And it was felt in some and other asset price growth. It was felt that for monetary policy to tackle that, you would have had to increase interest rates tremendously for that to have an effect, and that could have meant a total crash of the economy. Whereas in our case, what we did was that when we saw housing prices increasing, although we don't have good enough data of a systematic kind as like the housing price indices in the United States, even though we could observe certain kind of housing prices increasing. Second, we could observe housing finance growing very fast, like 40–50% a year. Similarly, we could see financing real estate growing very fast, of also banks lending to non-bank companies, etc. So in each of those cases, we use prudential regulatory methods, financial regulatory methods, to curb that growth, so that we didn't have to use the sledgehammer of monetary policy. So I think those are the kind of illustrations that I would make. I want to clarify that I'm not saying that everything we did was right, others should do that. I'm only providing those as illustrations of some of the ways that you can tackle it. In different countries may have different methods.
Are you saying that the Fed should have been the regulator in the States? Would that have worked?
I would say it differently, in that I do believe that different countries have legacies, different countries have different political economies in terms of traditions of sharing of power, etc. So I wouldn't say that, look, follow my example, because I don't believe that. What I do believe is that as the US Treasury paper is also suggesting, that you do need to have much better coordination between the Federal Reserve and the regulatory authorities. I don't want to go into the minutiae of sort of restructuring the US regulatory system, but what I do believe is that because the central bank is always ultimately the lender of last resort, so whether it is the United States, whether it's the UK, that what happened once the crisis hit, the central banks had to actually go and do their functions as lenders of last resort, whether it was to the investment banks, whether it was to Northern Rock, and whether it was lubricating the whole system through different new liquidity facilities. Given that that is the reality, the central bank has to be the lender of last resort, that whereas you might have different regulatory systems or maybe different authorities, I do believe that if you have some kind of a financial stability council or whatever, it ought to be the central bank that's heading that council.
Rakesh Mohan, former Deputy Governor of the Reserve Bank of India, thanks for joining us.